In this video lecture, we'll be talking about accounts, or more specifically T accounts, the ledger, and the chart of accounts. A T account is a record of increases and decreases for a specific asset, liability, equity, revenue, or expense account. We've been using the term account in one context up until this point. We've talked about a cash account, for example. We've talked about a supplies expense account, for example. So we used transaction analysis to increase and decrease the cash account. Revenue and expense accounts accumulate activity for the period. So essentially what we're going to see is that during an accounting period, you're pretty much only going to increase a revenue account and increase an expense account so that the balances in those accounts reflect activity to date. Asset, liability, and equity accounts, on the other hand, are cumulative, and they don't reflect just the activity for the current accounting period, but reflect all activity to date. So for example, the cash account. The cash account is increased when cash is received and decreased when cash is paid. The cash account will have a beginning balance in any period except the first. On the other hand, the revenue account is increased when a performance obligation is satisfied, which is generally at the point of the sale or delivery of the service. The balance in the revenue accounts reflects all revenue earned just for the period. The term ledger refers to all of the accounts and their balances, and a chart of accounts is a list of all the accounts in the ledger with an identifying number assigned to each one. Number sequences are assigned based on whether it is an asset, liability, or equity account. Recall that revenue, expense, and dividend accounts are a subclassification of retained earnings, or an equity account. So here is an example of our general ledger T accounts. So you can see that the assets are grouped together, the liabilities are grouped together, and then your equity accounts are grouped together. So in transaction analysis, we used a spreadsheet to accumulate the increases and decreases to specific accounts. In companies' actual accounting systems, they have computerized T accounts to represent each of the accounts in the ledger. So what we're going to do going forward is start talking about debits and credits and how they are used to record activity in the T accounts.